Okay, good morning, everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Wednesday, June 13th. Happy FOMC Day to everyone in the room. Michael Boutros here with you this morning. Lots to discuss. The interest rate decision is on tap later this afternoon. Obviously, we're expecting a 25 basis point hike, but there are a lot of different setups to cover. So good morning to Deborah, Dee, Jia, Kelly, Mark. We got all the Pete's in the room. Pooja, Ziad, as always. Great to see you guys in the room. So, want to go over again real quick. We kind of covered it over the last couple of days, but real brief overview again of what we're looking for in the FOMC with the release and the subsequent presser with Chairman Jerome Powell. Really, the whole focus is going to be on the shift of interest rate expectations, and we'll take a look at that. So we'll cover setups in the DXY, Euro, Sterling, Aussie, dollar CAD, not really messing with it, but hoping to see some resistance soon. Dollar yen, Aussie yen, dollar Swiss, which has been unchanged, did break the upside channel. So we're looking for a little bit of a stretch there, and gold still within the consolidation range. So if you have a setup that you would like to cover that you didn't hear mentioned, or if you have any questions throughout the session, guys, as always, feel free to throw them any questions on the message board. So let's get started. Here's the whole deal with today. I provided for you last night the link for the dot plot. This is what the central focus is going to be. Two things to pay attention to. The terminal rate has been consensus right around 3%, just shy of 2.9 its actual mean for the longer running rate. Okay, so this is basically what the Fed is targeting ultimately as far as interest rates are concerned. The mean consensus for the Fed members as it pertained to the March, this is the latest projection, was right around 2.25%. Okay. So that suggests if we get today's hike, which is priced in, which will take us to 2%, that suggests one more hike this year. The Fed has maintained this stance for some time, that we're going to get 3 hikes in 2018. The focus is on any deviation here or here, okay? If we see a deviation here, we suggest maybe we'll get, or this shifts even to 2.25 or 2.3, on a mean type of average, it would suggest that there's still a little bit more of dissension amongst Fed members, and we could get that 4th hike. That scenario would be constructive for the dollar near term. Now, from a technical standpoint, there's some room to stretch. We're still looking for the turn lower, ideally. And we'll go over that in a moment, but just to kind of keep in picture what we're looking for. So if you see this stretched higher, where you're seeing more Fed members voting for a 2.5 clip by the end of the year, that would suggest again that we'd get that 4th hike. Where do we stand now? Well, really quick, I'll come back to this really quick. Here's what the projections look like. So for June right now, 96, 97%. Basically, the markets have priced in a 25 basis point hike. Okay, that puts us at 2%. The important date, and this is the CME Fed Watch tool. Here's the link for you guys. So if you'd like to follow along throughout the day, you can always revisit this. The focus will be on December. Okay, if we go through the months, August, we're still expecting 2%. September, 72%, still expecting about 2%. November, starting at a little less, but about 70% roughly, still expecting 2%. December is when the next expected hike is. And if you look at this, the way you got to read this is you got to take these 2 numbers or these 3 numbers, anything to the right, and add them up. So this puts you basically just about 50% consensus that the next hike will be in December. Okay. We're looking for shifts or deviations in this one. Okay, and as this builds, that might offer some support to the dollar. All things held constant, guys. If the FOMC projections come out and they look exactly like they did here, okay, the dollar really has nothing to stretch on. Okay, here's the DXY since the start of the year. I've highlighted just the last 2 interest rate decisions. This one in March is when we saw the last interest rate hike of 25 basis points. That day, you saw the dollar really drift lower. Markets had already priced that in, no shift to any expectations. But this build here is the consensus market pricing in those 3 hikes. So, coming into this release out of these two, or, you can come back and look at the one that we got previously in January as well. But, looking at these two, this is pretty much similar to where we are now, coming off a multi-month high. You've seen a little bit of recovery, and we're going to get an interest rate hike, just like we did back here on March 21st. Coming off a multi-month high, seeing a little bit of recovery, and we're going to get an interest rate hike again. The question is shifts in expectation. If we see this move, or if we see the terminal rate move, meaning that more members see that the natural rate, the longer running rate, is a little bit higher given current market or economic conditions, again, that would also suggest that we're going to have to see that pace of hikes increase. Any questions on this stuff? One more thing that I just want to note, yesterday in the middle of the US session, kind of towards the afternoon, I don't know if you were watching the markets, you saw the dollar just start to rip higher out of nowhere. This was on a commentary that came out into the markets suggesting that Chairman Jerome Powell from the Federal Reserve is thinking or mulling over possibly putting a press conference at every single Fed meeting. Now, Mike, why the hell does that matter for anything? What that suggests, guys, is that every meeting is essentially live. The Fed has been, well, just looking historically, the Fed has rarely moved interest rates unless it was on one of these quarterly meetings where we get the projections, the updated outlooks, the Fed dot plot, right? We get all that released on a quarterly basis with the press conference. And those are the ones where the Fed is deciding to move to either hike or cut rates. If they suggest that they're going to put a press conference on the back of every single FOMC meeting, that would suggest that every meeting is live, giving the Fed far more flexibility with regards to the timing of when they can, when they can move on rates. Now, inherently, this is a big problem for markets because the whole transparency theme started by Bernanke and all this has just, it's just exacerbated market volatility, and expectations are all over the place, shifting on a month-to-month basis. So there's arguments to be made on both sides. I don't want to get into that. We want to look at price, but just to give you an overall picture, okay? If we see Powell drop this note in today's presser that he is looking to make a press conference on every single meeting, look for a lot of market volatility. Honestly, I can't tell you how that'll necessarily impact the dollar per se, but overall, you'll see volatility on this, guaranteed, if he notes these kind of commentary in the presser. So things to look at with the commentary. As far as the projections are concerned, here's what the projections looked like last time. Again, I provided the link for you right here. When the release comes out, guys, today, just click on that and you'll see it updated right here under PDF, just like here. And you'll see the latest projections. The last projections, you saw them upgrade the growth outlook in GDP from 2.5 to 2.7% this year, and also upgrade the employment outlook from 3.9 to 3.8%, which is where we are now. Inflation and core PCE stayed, steady. Remember that, excuse me, the Fed's main focus, or their mandate by Congress, their dual mandate, is price stability, which is inflation. Okay, their target is 2%. We're still running at 1.9. And maximum employment, and the natural quote unquote rate of unemployment is basically where we are now. Okay, longer running, we're actually below it. So it's very difficult for the Fed to really continue to delay further hikes. If anything, they might come out with a more neutral, or my personal expectation, guys, is they come out with a little bit more neutral of a tone, because growth outlook is starting to get softer. So they're not going to want to spook markets by saying, hey, there's a big likelihood that we're going to start to accelerate our interest rate hike outlook. A quick note, as we always like to do on Fed Day, we do get some proprietary research from an affiliate company of ours, Prattle. Here's what they're talking about with the Fed expectation for today. I'm just going to read it out for you real quick. It says likely raise rates by 25 basis point. In recent weeks, Fed policy makers have made a concrete effort to sound increasingly hawkish, signaling this week's rate hike. With inflation roughly at target and employment down to 3.8%, the US economy continues to appear fairly stable. However, GDP growth at roughly 2% continues to underperform given the relative strength of other indicators. This could drag on sentiment of this week's FOMC statement, keeping it near neutral as policymakers hedge regarding whether they will hike once or twice more in 2018. So again, just further highlighting their research, we're really focused on whether we're going to get that third and fourth hike in 2018. Okay? That's all I got on the fundy side. Any questions on anything from there? Let's just jump right into the charts if there are no other questions. Reversal bar on DXY and working on one on a daily. So Ty, listen, it's turning at a great level. The only concern I have with your statement there is you never want to make an assumption that's a daily reversal bar until we're getting closer to the close of the session. I mean, we haven't even opened US trade yet, right? And this can't be ascertained as a reversal bar until the close of the session, right? Because if we rally right through, it's not even going to be, it's as if it never happened. So you have to be mindful of calling daily reversals. But having said that, look where we turned from overnight, okay? Those dots here are the monthly open resistance. Oh, you're talking about a 12-hour. Okay, it's different. So you're talking about a different time frame. Reversal bar, okay. In general, you do have a couple of different reversals here, okay. What I was looking at this morning was this 4-hour hourly reversal bar outside hourly 4-hour 4-hour reversal, off the resistance region that we were watching. So here's what we're looking at with the DXY. And again, just a quick reminder of where we are in the weekly charts. On the weekly basis, heading into the close of the week, we do need to see price maintain a close below 94.20 for this thing to be viable for the pullback. Okay, that's been the whole stance since the start of May trade, right? We never really got that weekly close above 94.20, and it leaves it vulnerable for the pullback. On a daily chart, again, monthly open resistance is what we were looking at yesterday. We came perfectly there. There's 94.20, 94.27, again, highlighting the region of which on a weekly close we do need to see hold for there to be any hope for a downside in the DXY. Intraday, last night, it looked like this. We highlighted that this thing had made a clear weekly opening range. Here's your weekly open. You set a low, you test the low, go back into the highs, again, back into the highs, well set, right? We're still looking for clarity on what to do on the medium term. Intraday, we pushed just higher, but again, that 4-hour reversal, Ty, if you're looking at the 12-hour, it does look pretty good. Momentum turning right ahead of 60, it's exactly what you want to see. All things held constant, it does look good. But what I want to say is just a note of caution because we're heading into such big event risk, Ty. Any position that you have here, don't necessarily bail on it, but just make sure you're staying pretty nimble, okay? And bringing your stops in. You know, if you want to bring them to break even ahead of the release, you know, that's your prerogative based on your risk parameters, but expect volatility, okay? Because the subsequent presser, where we get all those questions from the chairman, is really where the markets tend to move the most. Now, where we turned, again, is pretty nice. Okay, if you're talking about this head and shoulders possible break, again, the measured move takes us down here. That being said, this is exactly what you want to see hold. If we break higher, let's say they come out a little bit more hawkish, again, that 94.20 region is where you want to see failure. Okay, if we blast through that, you're basically looking at resumption, dude, and the dollar has a lot of upside to go if that scenario materializes. So we know our levels. Near-term support is the weekly opening range lows, 93.43 is the basic 236 and former slope resistance. So a break below this objective region puts us right back on target. Okay. Any questions on DXY, Fed, anything like that? Okay, number 2, here's Euro. So, no surprise, Euro chart looks pretty much the inverse of DXY. We covered this, I think, at length yesterday, guys. Really nice area of support. Here's the rebound. Major resistance on the weekly charts, 119. 119.16. Just above that, you have the 52-week moving average. So there's a lot up here. Key support. Okay, your basic low close from October of last year. Basically looking at the 116 handle. So the weekly chart's pretty clear as far as the critical levels that we're looking for in euro. Daily chart. Here's what it looks like. Okay, no change from any of that charts that we looked at last night. Okay, 1827, interestingly enough, that's the 1618 from the decline, but it was a perfect tag of support, break, perfect tag of resistance, and it's been the monthly opening range high ever since the start of June. So again, that's the level to beat. 119.09, 119.16. Remember, we were just looking at this on the weekly chart. Big resistance, yearly open, 200-day moving average. That's basically at the 120 handle. So mapped out big levels here. 116.16 is the big support, and the monthly opening range low. Okay, on a spike lower today, if this is going to move higher, you kind of want to see the monthly open hold as support. So just as a note there, like I think it's 1690s, 116.90 exactly, is the monthly open. So like if we spike lower, the dollar index spikes that one last move higher, let's say on the release, those are the levels I'd be looking for to fade. Past that, again, you just got to let it drop if it goes lower. Do you have sessions at night, says Ty. No, I don't, Ty. I have an around the clock, pretty crazy schedule, so I don't do any live sessions at night, but I'll try to have some tweets out for you guys as soon as the release comes through. I'll go through the statement real quick and the projections, highlighting any variations to what we're expecting. Okay. He says you are reviewing last night. So Ty, what I do is I provide the levels for you ahead of Asia in the report. So if you see that, it says they're always discussed for the following day's price action. So I'll give you the setup on the 12th for the 13th. Does that make sense? So that's why in the webinars you'll see me going over last night's update, but I write this ahead of Asia. So for you in Asia, this is basically 6:13, the open of trade. He says thank you. You're more than welcome. I know you're new here, so more than happy to explain it to you. But for the euro, intraday, it looks like this, okay? And here's what we look like now heading into the release. So that downside, what looked like it could be a bull flag here, still could be in play, okay? I was looking for a re-entry. Obviously now on the swing side of things, we're long already, right? So swing trades, the stop was at 117.20, real close here to getting stopped out. So that held, we're still in that. On the way up, okay, this is kind of the region that we need to clear. 1827, the high that we made, the opening range highs for the week. That's going to be the break that fuels the next leg up. 119, okay. Next on the intraday chart, you have 119.45, 119.61. This 200% move here, this is the measured move for the possible inverse head and shoulders that we were looking at earlier. So the measured move, the target on that move is 119.46. 119.61 is the 1618 of that first leg up. So sort of this would be the breakout level to look for on a more extended break in the euro. Okay. First things first, though, look for resistance at these two regions. Guys, if the market starts to drift and break through this ahead of the release, really be cautious because those moves are typically faded right off the bat. I kind of don't want to see this break until we get the FOMC release, or at least the projections to know if we're going to see any deviations in expectations for interest rates. Any questions on euro? Here's the 120, and again, no change to any of the levels from yesterday. So ideally, we would have got another entry level here to add to that position. But it's a good thing that the swing trades are still in, so look for that break above 118.27 to get this thing going. Questions? So nice some hourly divergence here with the lows that we just made. New low in price, no new low in the oscillator, turn higher, textbook move. Look for resistance around that median line, but we need to break through 1827 to keep this going. If you're flat and you're looking for new positions, the play would be a one jackknife if it kind of spikes lower into the FOMC. Or if it breaks through 1827, do not chase. If you're not in already, you have to wait for the pullback. Try to get a stop against 1827 for the move into 119. So we'll see how this pans out today. All right, those are the euro levels. Number 3 is sterling dollar. Here is the British pound. Please put the cursor on the median line. Which median line? So you got this. This is just basic channel resistance. This is a parallel. This is basic channel resistance off the lows. Sometimes it's best to take it off the low in price, not necessarily what's, what looks like it matches best. So the low in price, match this, the break saw acceleration, kind of pivoted here as messy yesterday. But that converges on 1827. Again, why we need to kind of clear that pivot level. Look at 1827 on the daily chart. It's pretty basic. Support, bounce, break, resistance, resistance. That's the level to beat. Okay. Sterling looks like this. Pound, pound, pound. This is what I'm thinking on the pound. I mean, the support level that we were looking at held. The rally got us to where we were looking for. The question is, does this materialize into a bigger recovery for the pound, given where the dollar is? It's pretty clear. Okay, look, the 52-week moving average is basically at the highs for the week, 34.50s, 34.60s. The key support zone that we just turned ahead of was basically 130.180. We never quite got down there. The low was 130. What was it? 132.05 was the low. We came right off the handle. So this is your key range for sterling. A breach above last year's high week reversal close. So 135, 134.90. Is what would have us looking for a larger reversal. That would suggest that a more important low is already in. So the weekly charts, no change to any of the levels there on pound. Here's what the intraday chart looked like. We've been working with the same exact slope. Here's what it looks like now. Daily chart, and Jamie highlighted this as well on the swing charts last night, guys. Really nice parallel, right? Converges on the weekly, on the year, monthly open. So as long as we hold this, still looking for the assertive rebound more towards the yearly open at 135. Okay, intraday looks like this. So we started off the week in sterling saying we're basically looking for these two regions for possible exhaustions and long entries. The first region was 133.38. We kind of dipped right into that. You saw a nice rip right into channel resistance. It held strongly on the reversal. Second area was 33.02, 33.06. We came right into that last night. And again, the attempt is on the long side here. So don't want to get aggressive on this. Go break even ahead of the the release. If you have some profits and it's above 33.45, we're trading above this region ahead of the FOMC. I'm going to book as much as I can, put stops at break even, and see what happens. If we haven't taken anything off the table, it's going to be a hard call to kind of hold this, but you need to see a break through the weekly open to get this going. Here's the weekly open. And here's your near-term sort of target to the upside that you need to clear. It gives you a 34 handle, 34.07. Okay, a breach through this would sort of put us back on course for a larger recovery and would hopefully give us some structure. At that point, we tack on a pitchfork, maybe get a little bit more clarity on the slope, but that's sort of the game plan here for sterling. This is what we need to clear on the upside to really get things going. Below 33, I'm out. I have no interest in trying to fade it. Okay, if we break below this region, you have to be mindful of where we're trading in the broader picture of things. You know, we could see a larger drop right back into key support at 3180. That'd be down here. Okay. Okay. You did get CPI data, by the way, from the UK today. Came in right in line with expectations, 2.3%, 2.4% year on year. Core was at 2.1 as expected. So tomorrow you do get some retail sales data. Again, could offer a little bit more of a volatile session. But you know, we have the ECB on tap tomorrow, so don't put all your don't check off the event risk for the week just yet after today. Same thing for the euro. We didn't talk about the ECB, but guys, obviously the event risk tomorrow has big implications for the euro as well. It's all going to be about whether Mario Draghi and company, they're really going to start to tone down um, or start to ramp up, I should say, some sort of normalization. Remember, the timeline keeps running out and they keep extending it. So you would think that that would be constructive for euro if there is a more concrete, structured outlook. I don't know what he's going to say. I don't really care. I just want to know when that's happening, and that's going to be tomorrow morning, right ahead of the webinar. So keep that in mind. Okay, so that's pound and euro and DXY. Any questions on those? Let's see if pound can hold 133 here. Aussie, number 4. So this is where you kind of want to see this thing start to hold if we are moving lower. The start of the week, we were looking for the 50% or the 618 of this drop to offer some resistance. Again, we highlight both of those levels as far as where we would want to see sort of resistance. We did hold 76.19 as resistance, and we turned lower, breaking below the lower median line parallel. Here's the check of resistance and the weekly open. So if we're going to move lower in Aussie, you kind of want to start to see this thing peter out ahead of the 76 handle. That's confluence resistance here over the next couple of hours. Obviously, if we break 76.19, again, that's just an objective weekly opening range break. So we would be wrong on the downside. We'd be looking for higher. Remember, we were playing the long side here. Ultimately, the head and shoulders formation break was targeting 77. But the reversal that we got last week really kind of changed things. Is off 100% extension, which suggests correction, 2 equal legs up. So I'm kind of thinking that you peter out here. In the event of dollar strength, this is one I think you can get a downside move towards 75.30, 75.15, or 75.13 would be a basic 618 of the advance, right? Real clean level. Basic slope, that's down here. The monthly opening range, here's your June open. Your June monthly opening range lows is also right here. So any way you slice it, just above 75, 75.13, this whole region here is your key support barrier for Aussie. Bearish invalidation, the objective weekly high. So breach above this puts these targets back in sight into 77. Right now I'm looking for, or I'm hoping for a fizzle out here, an entry somewhere ahead of or into the Fed on a spike for a move lower towards 75.20s. But we'll see. Remember, ultimately for Aussie, I do want to see it move higher. I just think that the correction, it risks a deeper drop just based on how we turned and the break of this region now. So if our interpretation is correct, you still have one more low to make before you start to rally again. That's all predicated against 75.19. Put the order on the upper trend channel. So Ty, you kind of need to get a little bit closer to what our personal strategies are. From the swing trades, we'll put the entries on there for you on the swing updates. From an intraday trading, so for me, I kind of need to see what price does there. I don't just put blind orders ahead of event risk. Just not my style. A lot of guys like trading like that. For me personally, Michael Boutros, I During event risk, I'm quick on the trigger. So I'd rather sit there and watch what price action is doing, see what reaction we're getting. If the levels are responding, I'll accordingly jump in. You never want to just jump into the turn. The way you want to trade the turn, and again, I don't want to turn it into an educational piece per se, but real quick for you, Ty, the way you want to trade the turn, man, is when it comes into the target you're looking for, you want to see the pullback, and then you want to see failure. On that approach, your entry is against that high. You have a level trade against. If you take an entry here, the only place to responsibly put your stop would be against, the highs. And if this thing kind of spikes or just jumps through, I don't want to get stopped out and then it, comes in my favor. So for me, I always want to see what price action does. Maybe you get a spike right into the weekly high and it fails and it drops lower. Then you have a much more concrete high to trade against. But I'm not going to just fight the uptrend with a stop with an entry ahead of major event risk like that. Just my style, right? Swing trading is a whole different, type of practice. So on those trades, yeah, we'll put entries. But hope that offers some guidance there. So that is Aussie. Dollar CAD number 5. So I just put the CAD update here because interestingly enough, that same pitchfork we drew back on the 7th is still the same level that's been holding. So again, I'm not fighting dollar CAD. I've gotten stopped on this so many times on the short side, guys. It looks like it's holding. Again, initial move looks good. Go figure, just as I start to give up on it, it'll start to move. And that's typically how it starts to get you suckered in. But it looks good. The initial move looks good. Divergence wasn't really there is one thing I was looking at heading into last night's, before I hit the sack last night. I was trying to see if there's any entries here, but I just couldn't enter it. You got a last spike here in European trade, and here's the pullback. Too early to tell. Let's see how this materializes. Monthly the gap open support. So this is the Friday close. We gapped higher. The open for this week is actually up here at 129.90 something. So if we're going to fill that gap, tendency for markets to fill that gap, obviously being sort of focused for this trade, but with that same formation still in play, it's sort of a nice spot for this thing to hold, and it did that last night, right? So, if you took the trade, you got more guts than I did. I give you credit. Stops would be break even or against the highs heading into the release. Again, your first levels on the downside, the gap, again, to fill the gap, we would just need to satisfy and move into 29.25. So look for a reaction there. Wouldn't necessarily bail if we get down there. The bigger level is basic slope support off the April low. 1 touch, 2 touch. It converges on the 50 line. Okay, so that's down here somewhere around like basically just right at 29 would be your next level down. And those levels haven't changed from last night. All right. Look, there's not much data out of Looney. You do have crude inventories that comes out, ahead of the Fed release. The implications for crude prices, again, that correlation has really broken down last couple of days, so I would not give it too much credence at this point. But do know that is on tap today. Any questions on dollar CAD? By the way, quick reminder, hey, Ty says he's still learning. I'll read the tutorial. Yeah, Ty, no worries, man. You're in the right place for questions, so don't worry about it. But Ty, also keep in mind, I'll see a couple new names. You can always click on the camera button. There's a camera icon in the GoToWebinar screen to take a picture. All the charts that we're presenting so far are the same, but if you ever need an update, feel free to do that. Just wanted to show you the daily chart real quick. Again, why dollar CAD is an appealing short to me. Okay. Up trend 50 line, downtrend median line resistance. Okay. Weekly chart on dollar CAD. You know what I mean? So do or die, it's make or break here, in my humble opinion, for dollar CAD. It's been a rough couple of weeks, has just butted up against this resistance level, but it's do or die. All right, that is dollar CAD number 5. Number 6, the abomination. Why not, right? It's a major event risk day. Dollar yen is typically a big reactor to US data. Look, our bearish invalidation level was 110.14, so that quickly got invalidated with this break here. You know, 110.88, 110.84 is a level I'm looking for a possible exhaustion play. You got the November lows. If you zoom back out on the daily chart right here, okay, then you got a key 618 retracement and a nice pivot there last month. So sort of a region of which if we start to spike higher would be nice. I was hoping to get some divergence here. We didn't. So I've got no skin in this game at all, guys, for dollar yen, but levels to know for today. If we spike higher, 110.88, 110.84 is a level I would look for a reaction. If we get through that, if you're holding longs, I think you're golden. That's the level to be. You're looking at 111.35, 111.60 on the upside beyond that as topside targets. If you're looking for fresh exposure from here, I really got nothing for you. You have to wait for the release. If it spikes into this region and it holds on the pullback, I take a short against that stop, against that high, looking to play the downside targets toward the median line. But other than that, I got no skin in dollar yen. I'm just not playing with it. Until this break right here, guys, this formation has actually been pretty clean. A slightly different slope than we're working with on the daily chart, if you notice. But look at this parallel. Resistance, 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 acceleration, support, support, break, resistance, resistance, resistance until this. So, you can discount this as a false break if we do get some more downside, but, ahead of the FOMC, I'm not going to hop in a short here against that high. Just not my style. So if we get one more spike into this region, would be great. Like I said, beyond here, there's a lot of room on the upside before you start to look anywhere to start to fade anything here again. Questions on dollar yen. Keep in mind, for dollar yen, you still do have the Bank of Japan interest rate decision heading to the close of the week. So event risk by no means is done there. I think this BOJ meeting might actually produce something, just as far as where the stance is and what they're targeting with the inflation and whether they're going to move that, or keep that, or all the speculation, right? So whatever. That's later this week. Just do keep in mind that the event risk for dollar yen is still there. So that is dollar yen. Not a favorite play of mine, but those are the levels to know. Again, on the daily chart, those are pretty the same. Just want to show you the weekly chart. The whole region of resistance, 111.64 into 110.88, is what we've been watching ever since the reversal here. That's where we posted this weekly outside reversal. So I kind of, don't want to see price get in here again if we're turning lower. Obviously on a stab higher, that 111.64 level is still the level to watch. Basic 50% of the decline from, that high in late 2016. Also keep in mind, this is the weekly charts. So you have the 52-week moving average, which you're kind of pushing through here, but it's really going to be determined by, whether the weekly close is able to make it above or below that level. So we'll see what it holds in store for the abomination. As far as the yen crosses are concerned, someone here was asking about euro yen yesterday. Was that here? Remind me who you are if you're in the room. Aussie yen is the one I threw on the message on the report yesterday, guys, just to remind you again where we are there. In the event, since we're looking for an Aussie pullback, here's dollar yen, by the way, no change to those levels. We kind of broke through this and pulled back, so leave those unchanged. But Aussie yen, this is kind of this is kind of the yen cross. If you put a gun to my head, this is what I'd be looking at. And it looks, because of that turn we got from 84.12 yesterday, it looked pretty decent. Now, obviously, we came right back through, or we're coming right back into it. Here's the weekly chart of Aussie yen and why we were initially looking for downside exposure. Key range highs, very simple. We've been in this range since April, right? Key well-defined support, key well-defined resistance, 20 is M17 open. You got the 100% extension from the highs, or from the lows rather. Gave you this range here. So we're kind of fading moves off that range has been a decent play. So Aussie yen on the daily now looks like this. Okay. Within that range, that objective range on the daily chart, you have this upslope. This is basic slope support. A parallel caught these three lows. A parallel caught this high, caught this high, caught this high. So again, after this, big old outside reversal day that we made here on the 7th, that shifts the focus lower, towards a more of a correctionary stance. So one more low towards 82.34, specifically 82, is kind of what would have been, the sweet spot for me on a pullback in Aussie yen. Hasn't really materialized yet. Here's the intraday chart. Nothing's necessarily been invalidated, but it kind of lost steam, right? And this is what I was saying yesterday. I was saying, well, it looks pretty good, but let's see if we can pick up some steam here on the pullback, because it obviously fizzled out real quick. Here's a little bit of rebound. Nothing to worry about just yet. But if you're in this trade, guys, again, I would go break even. It's a risk-sensitive pair. So if you see anything, really radical outside of the Fed today, I wouldn't want to get caught just taking a stop on this for no reason, because we were right on the initial entry. So stops at break even, but basically we want to see it hold below this median line, below this basic parallel, basic resistance, whatever you want to call it, for the move lower. The weekly open comes in at 82.95. They got the 50% at 82.51, just below last week's swing low. But this is kind of where you want to start to see things hold if we are heading lower. Now, if markets just blast off, right, there's huge surge in market sentiment. If we make it through 84.20, I would still be neutral in this range here. Obviously, this is just the objective range highs, right? So 84.50, that would be the break that clears the way. For 85, 84.80 would just be a soft target. 85 is big. That's the 100% extension off the low, right? 85.40, you got the confluence of the 200-day move average and 50% retracement. So you got the levels mapped out on both sides. Ideal scenario, you get another low here towards one of these two levels. You need yen help for that, though. You need yen help. So let's see if we can't get some strength in the yen. Another trade that if it doesn't get a good response today, you still have the BOJ on Friday. So we'll get some play here one way or another. That's number 7. Okay, number 8. Sorry, just jumped over dollar Swiss here for a sec, but here's what dollar Swissy looks like. There was no change to that, so here's just a link to the previous night's update. Dollar Swiss, until last night, we were still trading within this descending channel formation. We've since broken and taken out 98.90. Okay, is that first level of influence as far as resistance is concerned. Where do we go from here? Well, we'd have to still hold above that 98.45 level, but that was the first sort of target. So if you're in that, you're kind of going to get washed out at this point. Still think you could get that last spike higher if we do get a dollar bullish reaction initially today, which would look for a fade. Remember, we started the week looking for a move towards one of these two targets to fade. So this breakout was welcomed, but it looks like we're kind of mean reverting back again. Remember, the weekly open actually comes in with that same level of support that we've been looking at, which is 98.45. Weekly open comes in 98.44. Interesting. Yeah, we'll keep an eye on this one. If it breaks down, here's Swissy on the weekly charts, by the way, just to get a picture of where we are. This is why I thought the rebound had a little bit more legs in it, because it came off of former slope support former slope resistance turned support so well last week. You got right into it and then you closed right back at the 2018 opening range high. So for me, I thought it was a little bit more upslope on this before you turn over. Could be wrong, obviously, but that's sort of the thought process that we're on with dollar Swiss. So I wouldn't, gang bang right on this just yet to the downside. It still could see that spike today to wash people out before it moves lower. Disclaimer, I don't have any positions on this just yet, but I'll be hunting this one today. Questions on Swissy? All right, that's sort of the last dollar cross. Anyone looking at Kiwi by any chance? I haven't been talking about it too much on the intraday charts, but it's actually the strongest performer versus the dollar today heading to the release. Interestingly enough, I kind of just wanted to highlight that. You're up almost 0.5% already on the session, which is a lot considering this week's range, right? I just don't have a real clear indication of where Kiwi goes from here, guys. So I'd caution you in this pair. The only thing that does look appealing to me is just an objective monthly opening range. Obviously, your monthly opening range lows at 69.56 or so. That's a fib extension we've been watching anyway. Opening range highs for the month, pretty steady, just around 70, 60. So, look for a break of that is kind of the objective thing to look for, but just hasn't been my cup of tea. Here's Kiwi on the weekly charts. Kind of broke below support, didn't really do much, dangled a little bit. So I think, you could see a little bit more upside. Again, low conviction. Just wanted to highlight that for you. Gold, something that actually is going to be a functional play today. Now, the congestion region that we've been looking for, here's gold on the daily charts. I do want to highlight gold on the weekly charts, probably most importantly, because it's so clear and objective. The consolidation range that we're looking for. So you're looking for a weekly close either above the 2018 open at 1302 or a weekly close below 1285 to clear the way for the next move in gold prices. The ideal play would be a break to the upside for a recovery if the dollar pulls back, right? For that to happen, you would need to be a little bit more neutral to dovish on the Fed, in my humble opinion. But we'll see how that pans out. Just note that momentum on the weekly chart is grounding out. The last couple of times momentum has reached into these regions. Obviously, they've produced some pretty decent bounces. You didn't really get that here, so this dead cat bounce might be sort of the pause before the continued breakdown. We'll see. Here's what the intraday charts look like, and this is why I was telling you guys not to position on this one just yet. Really clear, really well-defined monthly opening range just below the yearly open. You don't get these too often, but when they break, the break is typically substantial. So your yearly open resistance, just above that, okay, you have former swing highs, former swing lows, okay, 52-week moving average, 1306. Downside support confluence is that 1285 level that we grounded on last month. So the levels are clear on the daily chart and the weekly chart. Daily resistance trigger also is clear. So if we were to break above 1302, specifically 1306, and momentum clears this 3-point resistance trigger, again, that would be confirmation for a larger breakout in gold. Intraday looks like this. You still have a near-term consolidation, really nice. You got your third tag of support again today. So there's two, there's this one, which is now a little bit more in play for me. I have 1 tag, 2 tags, 3 tags. I'll count that as a 4th tag. There was this slope, which is a little bit steeper. You got that third tag kind of, held on a closed basis, whatever. Don't stress that now. The shallow slope looks a little bit better. Look for a consolidation break, On the end of the day, above 1305 is the breach you need to clear a breakout. Downside support below 1291. There's that 1285 level. Again, we grounded there last month. That would be sort of the breakdown, if you will, to clear the downside of that formation. But you'll see a move here. We didn't get it on the CPI release, which is another thing that typically moves gold. Other than that, interest rate expectations are going to be a huge factor for gold traders. Do you use candle rules to enter on the 120-minute chart? I don't really use candle rules as an entry in general, Ty. a candlestick formation has merit to me when it's coming off of a region I'm watching already. So for example, if we do an outside candle, outside reversal candle rather, off of the resistance region I'm looking at, like we did yesterday. What were we just covering? Where did that happen yesterday? Aussie yen? Here. If you get an outside reversal candle off resistance, then the candlestick formation adds merit, Ty. It gives me further conviction. But I will never enter a trade sheerly based on just a candlestick rule. Remember, when you're looking to enter a position, you want to line up as many pieces of evidence that you can to support your thesis. So if I'm looking for resistance and I'm looking for divergence in momentum and I'm looking for an entry, that candlestick formation adds fuel to the fire. Maybe I'll add a little bit more leverage on that trade, right? Press a little bit harder. So I use these factors in essence as a way to dictate how big of a trade I'm going to put on, how big of a conviction it is I have on the position. But just based on candlesticks alone, candles can be late like oscillators. Yeah, Ty, exactly. You're proving my point, right? So this is a 2-hour chart. By the time this 2-hour candle closes, what am I going to do? Now I'm going to get in down here. Well, the next, 2-hour candle got me an entry way closer again. So this now confirms what I'm looking at. So now I'm looking for entry. Then I jump into like a 30-minute or a 15-minute, right? Something real close. And I look for the next move higher to get a stop against that high as close as I can. As close as I can. You never want to trade the initial approach because you don't know, guys. Resistance is made to be broken. Support is made to be broken. So I'm not going to put all my marbles right against that level. I want to see a reaction lower. Then on the recovery, I want to see failure. And this is the entry. So I have very minimal stops. Ty, I try to get like a 15, 20 pips on a stretch, is usually my typical stop. Because if I'm going to hurt, I'm going to hurt quick and I'll take it like a Band-Aid. And if I'm right, well, then I have a really good position against a high that I'm trading against. So it's all about, knowing the direction's only 50%. It's all about having a setup, proper risk to reward ratio, proper game plan. All right. So that's gold. Euro yen, which again, someone asked about here yesterday. Here's what it looks like. I just wanted to highlight that crazy channel that we drew is still in play. I was looking at this morning with kind of like disbelief, but it's still there. We're just like, it's pressing it. So again, this if we were to move higher, that 31 level that we were talking about yesterday, still confluence resistance with basic slope. So that's still kind of the upside region that you would look for on the breakout here for Euro yen. Near-term support still 29.30s or so. The swing lows from here basically. Okay. Cup and handle could be a cup and handle. It's a stretch. Could be. My problem with this trade is that I think, again, just going in congruent with what we're looking at with the euro, I think if the euro is able to hold these levels down here and we do break higher, I want to see yen strength, which is kind of what's making me really kind of iffy about euro yen. So if we get euro strength and yen strength, the euro yen trade might not be your best kind of bet. So that's where I just kind of stray away from that euro cross pair. Aussie yen would be the better bet because I want yen strength, and at the same time, I think Aussie, does want to see a little bit more of a pullback before we resume higher. Ultimately, I think Aussie does have some more upside, but I think the risk here, might be again for a hold below that 76 handle essentially, one last drop. It's gonna be an interesting day. So guys, that's everything I have on my end. Let me know if you have any questions that I can help you out with. Do you manage your trades manually? What front end do you use? Yeah, I absolutely manage all my trades manually, Ty. Once I get into the position, my limit and stop, that's like obviously non-negotiable, right? Never want to jump into a position without a stop. That's just, doesn't make any sense. So the stop is always in play, but as the trade progresses, I'm a big believer in fading out of the position. So as you hit the first target, you take a little off the trade tie, you bring your stop to break even right off the bat. As you hit the next target, you take a little bit more off, bring your stop into the money, right? And so forth. So in that way, I can kind of ride some winners. Now, a lot of the times I'll take a little bit off and we'll get stopped at break even. It's frustrating, right? But you always have that option to get back in at no cost, right? You took the break even stop. So I'm really working with, I'm really very, very stringent and disciplined when it comes to that. I love your tight work with 15 to 20 pips. Ty, again, that's just because I'm typically a little bit of a heavier leverage trader. So I don't have the risk tolerance to sit in a trade down 50 pips, 60 pips. I just don't have it. Now, when we're trading on the swing side of things, I have a separate account on that. That's completely separate. I'm much smaller in the leverage. I can withstand a 60 pip stop. It's not the end of the world. But because I have so many trades on a daily, weekly basis, I don't want to put too much emphasis in a trade. Very rarely you'll find me sitting in a trade that's like 40 pips against me and I don't know what to do. Never happens. And that's just because you have to maintain discipline. So yeah, I hope that offers some help. He says, me too. Right on, man. It's all based on your personality. And you have to kind of recognizing your own personality is one of the main parts that makes you a good trader. You know what kind of strategy works best for you. Either you're a guy who can sit in position, you're a little bit more of a sit and hold, you have a longer term opinion you want to express. My strategy has been developed over the years from being seated on the trade desk for so many years, clearing on prop desks, guys, clearing client trades just literally all day long. So for me, I wouldn't want to sit in a position for a couple of days on end. I really wanted to take a little bit more of an aggressive approach, and obviously trading the firm's funds. You want to be in and out of positions as often as possible. So a little bit about myself there, but anyway, today's FOMC interest rate decision does promise to be interesting, guys. We'll try to keep you updated on SB Squawk as far as what the interest rate decision holds. And remember, the 2:30 time is when we start to get the presser with Powell. And again, the questions are always going to be telling, right? Where the FOMC stands, where the committee is there dissension, or is there a lot of consensus amongst them on where rates move forward? Remember, we're expecting 3. The question is, do we get the 4th? And we'll be watching interest rate expectations for that. Best of luck trading. We will pick you up. SB Squawk Ty is the Twitter handle. So if you're new, I don't know if you've done it yet or not already, Ty, just go to the homepage, click on this sign up form right here, complete this, and then once you're done, you still have to go to our Twitter page and just submit a request form. And that way you'll have access to this Twitter stream right here on your own Twitter handle. So this is where we give you like the nearest up-to-date updates throughout the course of the day on anything that we're doing, with adjusting any new positions or any new positions that we add on. Okay. Can I get it without signing up to Twitter? No, Ty, you need to have a Twitter account. Twitter is a great resource for any and all traders. I really recommend it, as long as you're following the right sources, legitimate sources, not too many opinions. It can be a great, resource. So I definitely actually recommend that for you, Ty. But if you don't want to follow it, the SB Squawk is always going to be on the homepage. Just make sure you keep this page refreshed. All right, guys. Best of luck trading. I'll see you all tomorrow morning. Cheers.